Hey, Peter Rose, Longwood Currency Trading. Another day walking in the snow. Take the dog out for a walk. My turn today. It's really cold and it's really slippery out in the ice. So I don't know what the result of that is. And there's the aforesaid mentioned dog. So there are two ways that you can manage a losing trade. You can get the fuck out of the thing. Or there is another way. Other than getting out and looking at the position that you're in, you got into the position because you felt strongly about the potential for that to work out, right? And so it goes bad, it goes against you. Now, if you don't have a hard stop, or you think that the situation has changed or whatever, even though the thing is going against you, that this trade is still a viable thing. Now, let me back up just a little bit here. I'm speaking more in terms from a day trader standpoint than from a longer term trader standpoint. If you go in a long-term trade, let's say you're managing a trade on a 1 hour chart, okay, and it goes bad against you, and then you jump up to a daily chart and manage it on that, that's a little different animal altogether, and probably not the thing to do, because your perspective changes. Your comfortability with trading on the 1 hour chart all of a sudden becomes complicated because now you're up on the 4 hour, you're up on the daily. I just don't suggest that you do it, because it's like, I don't know, it's like sailing. If you've ever sailed a boat before, you're driving a car. But in sailing, you know, you just get used to sailing in a particular kind of boat. You know, you get a 14-foot class boat, and all of a sudden you go to an 18-foot or a 22-foot. And sailing is sailing, but the boat handles differently. Maybe the jib's going to grab a little bit more air and cause some differences in the way that the boat steers. Trading is the same thing. You have to specialize. What are you going to be, a fucking doctor? Oh, I got my medical degree, let's see, you come to me with a crushed toe, so I'm going to do an orthopedic deal on you, and then you come to me with a kidney infection, and it turns out to be really, really serious, so you need a kidney operation, so I'll do that too. Well, you know, they used to do that back in the, you know, 1600s or whatever. You just do everything, because that's the best they could do. They had enough doctors, they didn't have enough specialty. You got to specialize. And so you got to apply that to trading. That's a business or an occupation, just like anything else. So if you're trading on the 1 hour charts, that's where you trade. That's where you belong. Don't change the rules or the playing field. You have to become an expert at that. That's why I'm an advocate of trading one currency, maybe two, as you get a little bit more experience. But once you start doing all kinds of stuff, you better be really, really, really skillful. You better have years and years and years of trading behind you before you do that. And if you have that kind of trading, you're not listening to this video. So you're listening to this video because you're 5 years or under in trading. Maybe 5 months or under in trading. So it's just advice. Specialize in what you're doing. So managing a trade on a longer term chart is going to be different than you know how I would manage it on a day as a day trader on a shorter term chart. And so that's what we want to talk about. On the shorter term charts, when you take your initial loss, when the thing goes against you, you know, it's 8, 10, 15 pips and you're out, because you're not looking for more than 25 or 30 pips on a particular trade. And so, you know, you just get out. Well, let's just say that you're at that 8 or 10 pip stop point, and you're looking at the situation, and God forbid you're listening to the news like I did. I did a video on that about watching the fucking news. But for whatever bizarre reason, you've now gone from what should be a 0.5% loss on your trade, and you're at 4 or 5%. And you're saying, everything that I felt about when I originally took this trade is still valid. I don't know why the fuck this thing is happening the way it's happening. Now, conventional wisdom would say, well, you got to play the cards that you're dealt, not the cards that you want to get dealt. And you can't project into a position what you think or what you want, but you're still in the position, and you still have structure around you and all your rules and how or whatever you use to trade. And if those conditions are still valid, then the original idea of the trade, it's still a good idea. It's just that it's going against you. Well, how far against you can it go? Well, you say, well, yeah, you'll get out if it's 2% against you. Well, what the fuck does 2% have to do with the trade itself? The market doesn't know that, 2% it should be as far as it'll go against you, and then it's going to turn around and everything is going to be okay if it turns around before that. It has no knowledge of that. You're the only one that can look at the structures that are there and around you and interpret them to the best of your ability as to what you think is going to happen. If those conditions are still good and you find yourself 3% down or whatever, how much pain are you willing to take? I was in a position at one point where I was 5% down, and I made a decision that I would stay with it because of certain conditions that I was looking at. And I'm also referring up to the larger time frame charts just to look and see what's going on in the macro world of things. Not that I'm going to trade up there necessarily. Although if you do make this particular type of trade management decision, you may very well end up in a carry trade. So you better know what the long-term issues are. Are you in a daily uptrend chart and you're trading short on a 5-minute or 15-minute chart? You can't reflect on hanging on to that. You made a mistake. But okay, let's say you did everything the right way and you're stuck. So how do you manage that trade then? How do you come back? Speaking of managing the trade, I'm supposed to be managing the dog. Bo, come on. There he goes. So, okay, so there are two ways of managing a trade that's going against you. One is just to get out. We've gone beyond that. The second is, let's say you're, in a trade. You're in a long trade, and it's going against you, and you're 4 or 5% out, and then it starts to turn around and it starts to go back in the long direction. Your profit target, let's say you're 40 pips out in the wrong way, and your profit target was 30 pips above your take point. So you're 40 pips below the take point. Your profit target is 30 pips above the take point. From a risk management standpoint, from a reward to risk basis, you're just under 1-to-1. Or I'm saying you're just over that 1-to-1. You get a little bit more risk than you have as a reward, but nothing severe. But 40 pips is 40 pips. And you're convinced that the thing is going to go your way. So you're averaged at your take point 40 pips away. So if you were to average down at this point and double up on your lots, your average loss would be 20 pips times 2, still $40 or $400 or whatever that is from a dollar standpoint, but you've gone from a 40 pip loss point to 20 pip loss point. But you've averaged down, and man, that's the kiss of death. You don't want to do that. But what you could do is, as the price turns around from its low and it starts to head back up, when it gets to some structural trigger point that would indicate it's gone through some resistance level, and now that's the floor, and it now forms some support, it's gone through that, and it seems to be going up further than that. Look, that could be, from your 40 pip down standpoint, that could be 5 pips up, 10 pips up, whatever that is. You see the thing is starting to turn around. You're judging this thing in exactly the same way you would in a profitable scenario where the price, what I call it, starts to chatter on you, and you go, well, this thing is going to turn around, I'm going to get out. Well, in this instance, as price starts to chatter and turn around and go back up, you get in with another position, get in with another trade. You add a transaction to the trade. So if you were 1 lot in, you'd add a lot. If you were 3 lots in, you might add 1 or 2 lots and stage your way into the trade as it moved up. Each time you add a lot, the price has to come to you. You can't catch a falling knife. The thing is falling. Oh, it can't fall any further. I'm gonna give out. That isn't gonna work. You have to wait until the price turns around and is actually moving in the direction that you thought that it should be moving in, because the price reaction, in this case a negative price reaction, could very well be a large institutional trader recognizing that he's got to get out of his position for his client, and so he's taking a final stab at collecting inventory so he can bail out of his position. And so that could be just a huge one of those, it may not end up as a pin bar. Okay, it doesn't have to be as dramatic as that. But he's done. He comes down, he flushes this thing out, he picks up, and the price is going to continue in the direction that it was moving in. So that gives you about a 50% validation for adding to your position. You didn't add an average down. The effect was averaging down, but you didn't do it on a falling price. You did it on a rising price. And what you have to do is you have to look at that. If I just walked in to the trading platform, I got up in the morning and I looked at it, here's the position that I'm in, and I've seen this price turn around, I believe I'll take a long trade there. That's the certainty that you need to have in order to manage that position by adding lots, even though you're underwater on the original position. And if you do that, that's no more stupid or reckless than taking the trade in the first place. But you better know what you're doing in order to manage the trade that way, because it's not for the faint of heart, and it's certainly not for you as a beginner. If you're a beginning trader with less than a year's experience, my advice to you is set a fixed pip stop, whether you're a day trader or you're a long-term trader, and when your stop gets hit, get out. It's just that those of us that are a little more experienced say, well, I may lose big time today if I get this wrong, but tomorrow I'll come out ahead, and the day after I'll come out ahead, and I've got a win-loss ratio of 70% or 68% or 63% or whatever, and so I'll make that up. Now, I've been in a position before where I've started out, sometimes you just start the clock over on your account. You say, okay, I'm going to try this new process, and I'm gonna track these results starting with this basis, $30,000 or $3,000 or whatever that happens to be, and I'm gonna try to do this thing again. And what happens, or what happened to me one time, and this is what happened when I, when I started trading my first real big live account with $40,000 that I lost very quickly. When I started trading that account out, I won my first trade, and then I lost a little bit, and then I won a little bit. But it wasn't very long into that process of opening that $40,000 balance account that I hit 6 losing trades in a row. Now, two problems where I was at that point is that I was over leveraged to start with, and I was I didn't have quite the firm grasp on the rules that I have now as far as risk management go, and so I did not reduce the size of my position under the losses that I was having. When you're over leveraged and you lose, you've got to really drop your leverage down. If you're not over leveraged, if your leverage is really, really good, you're in best practices, and you get those 6 losses in a row, you might very well be able to just hold on and trade that same amount. So if I was trading a $3,000 account and I lost 6 times in a row, and my pain point was, say, 10 pips, I've lost I've traded three lots. I'm losing $30 a time. So 6 times, or $30 times 6 times, 6 losses is $180. So that's you could stay with that as you go through, because you've got the runway in the account built in. When I trade an account, I always say, what would my position be if I lost 6 times right up front with no winners? And what would my position be if I lost 10 times in a row right up front? And so when you're trading, you figure the amount of leverage that you want to use based on the fact that if you lost 10 times in a row, you'd still be able to trade. If you're not doing that, guys, you really need to take that into consideration, because otherwise you can't sit at the table. Warren Buffett said 2 rules of investing. Number 1, don't lose money. And number 2, rule number 2 is see rule number 1. Well, he didn't mean don't lose money. What he meant was don't lose all your money, because if you lose all your money, you can't step up to the table to play again. And you just have to manage this stuff. So if you're in a position where you've just funded your account and you're lightly funded on that account, or you've lost some money before and the value of that account is down, but you're still trading the full leverage that you started out with that account, then you can't manage a losing trade by what I'm telling you. You just can't, because what happens if it goes wrong? I mean, that's the first question you ask yourself. Okay, this thing is coming back and I'm going to double up. What happens if this fucker goes against me? I'm 4% down, I've doubled up. Where do I get out at that point if that goes down? Do I get out at the point where I took the new position? Do I get out at the point where price turned around? Where exactly do I get out? And what I always figure is, if I'm 4% down when I go into that, I have to be willing and look at the situation and take an 8% risk against that bank. You just have to. So if you're not willing to do that, then you're not a fucking trader. And you don't have the skill in order to make that money back. It'll take you a while to make that money back, even if you're a good trader. So you don't do this every third day, right? It's just when you get really caught in a jam that you'd want to even consider managing to trade in this particular situation. It isn't suicide, but it does have to be done very, very, very carefully and very well thought out. And to correspond with that is really the fundamental process of successful trading is how much ever money you have in your account, you only trade with about 3/4 of that. So if you had, well, I mean, you know, if you have $1,000 in your account, it's just not much you can do because you don't want to trade many lots. But let's say you had a $5,000 account, where you're only going to want to trade safely 3 mini lots out of the 5 mini lots, because if you end up in one of these catastrophic positions where you take a 10% hit against your bank on a particular trade like that, then you want to make sure that it isn't the 10% on the $3,000 that you're looking at. It's going to be, you now have to shift your profit thing and look at your entire bank and say, well, I haven't lost 3% because for the day, that's not how I look at my overall standing as a trader. You have to look at the overall account. So instead of dividing the 10% loss, the $30, you have to divide that by $5,000. And so the loss isn't quite as great. It's half, right? But it's a little less than half. Half of that loss. And so instead of 10%, you're about 6.5% on your bank, on your total bank, not on your risk. I mean, you could play games like yourself and convince yourself that you're a hero and you're doing the right thing and end up, you know, losing it all and being broke. I didn't have these risk management factors nailed down, didn't understand them, didn't know about them when I first started trading. And so that's why I continued to trade with my same levered up amount when I went into my 6 losing trades. Those 6 losing trades cost me, oh man, I'll bet they cost me, I think probably $15,000, just right off the top. And then I continued for a while, continuing to trade over leveraged, and then you're starting to trade scared because you're trying to protect what you have instead of being careful and having it grow, because you're trying to make it up, and you can never make it up. My hands are cold. Stick a hand in a pocket here, because you can never make that up. In any event, the 2 ways of managing a trade that's gone against you is you just get out and take the hit. How many times has that happened where I've ended up needing to manage the trade instead of just taking the hit, and because I can easily make up a 2% loss. That's easy. But to make up a 4 or 6% loss or 10% loss, holy shit, man, that takes too much work. Peter Rose, Longwood Currency Trading. Have a great day, and look, try to have a good trading day too.